what struck me really interestingly in the gold market was that, as you know, when you trade in a market, if you can predict with a high level of accuracy the direction the price is going in the next minute, you can become really rich. And so when I started looking at the gold prices, I realized that around the fixing time, so when these prices were being set, prices dropped in some of the years 80% of the time. And they always dropped by much more than half. So I wish I had known these a long time ago. I would have put my bets on price drops around the gold fixing and would have made a lot of money legally without having manipulated anything. But that was only because I could predict accurately the direction of the prices. So that was one of the things that triggered my interest, was not just the structure of how these prices were set and how it was easy to move them, but also how prices did not seem to behave consistently with an efficient market. And this is a fairly liquid market. And so that led me to believe there was some level of, in the litigation world, we talk artificiality going on. There was something else that was leading to these price changes that were not just normal market movements.
We're talking about antitrust and market manipulation with somebody who is an expert in those fields. She is Rosa Abrantes-Metz, the managing director of BRG, a global consulting firm. Previously, she's worked as an economist at the Federal Trade Commission, as well as having taught at NYU and the University of Chicago. Rosa, welcome to the show. A pleasure to speak with you today.
Thank you so much for having me.
Our viewers, being investors and traders, are always interested in learning about how market manipulation is classified by regulators. You worked on several high-profile cases. You've testified against companies who have been found guilty of market manipulation. So let's maybe walk through one or two cases that you've worked on in the past and explain to our audience how they've been found guilty, what exactly constituted market manipulation, and ultimately how we can identify this as traders. But maybe let's talk about a specific case you worked on.
Well, I have worked on probably 20 to 30 manipulation cases, and I can tell you that no case is equal to the others. If there's one thing that manipulators have, is a lot of creativity, and different markets have different conditions. So there's different ways, depending on how price is set, there are different ways of manipulating prices. I have worked and helped uncover the LIBOR manipulation, and also some of my work with co-authors helped launch investigations in the gold and silver markets in 2014. And more recently, I've testified for the US government against BP on a natural gas manipulation in which BP was found guilty of manipulating prices in 2008 during the peak of the financial crisis. But let me talk a little bit about the gold case, which is a case that is close to my heart. So in a lot of markets, when you think about what's the price of a commodity, typically there's a price that is set at a particular time of the day. And that price is taken as the price of this commodity at a particular moment in time. There's usually a cash price and a futures price. So in this case, we had, I focused on the cash or spot price. And the question then becomes, well, is collusion and manipulation likely to occur when that price is set? Well, usually there is an incentive to move prices because typically companies have, and banks as well, a lot of derivatives that depend on the value that that commodity is going to take. So there's an incentive financially to try and move prices up or down, depending on which side of the trade you're on. But the question then becomes, is there an ability to do it? And that depends on the structure with which some of these prices are set. In the case of gold, there was this fixing that existed for 100 years, led by a group in the UK. And at the time, there were 5 banks that got together on a call that was not public. They themselves got together in this call. They discussed what their clients and their own positions were for gold and ran presumably an auction. And from that auction, depending on whether there was more demand or more supply, prices for gold, spot gold, would be determined. There were two of these calls each day, the AM and the PM fixing. Now you can see potentially a lot of problems with this setting. One, there was only 5 banks. That's a pretty small group. Typically, you don't like competitors to be talking to each other that directly, because that provides an opportunity to rig prices. Second, there was no independent oversight. So we don't quite know exactly everything they talked about. So eventually, when concerns were raised, some of these calls were monitored, but not most of the time. And third, they had a lot of interest in the direction prices should go. And fourth, they knew the direction the price was about to go before the rest of the market, because they had this private call. They knew immediately that if demand was larger than supply or supply larger than demand, that means price is going to go up or prices are going to go down. And the rest of the market participants did not know that. So even aside from whether they had the ability to move prices, which they did have the ability, they also had private information that nobody else had, and they could immediately position themselves to benefit from that private information. So some of my work in 2014 explained that the structure of these price setting was highly conducive to abuse. And several investigations were launched around the world. There were many lawsuits. My understanding is that many of them ended up settling. But out of these came other investigations into spoofing, when it is when, for example, market participants put forward offers to buy or bid, offers to sell or bids to buy a commodity or a product that they never really intend to execute. So they're fooling the market.
I think the biggest one you're referring to is JP Morgan's spoofing case, fined for $900 million, I believe. But let's go back to the 5 banks. Are you talking about 2014? Because you mentioned gold was fixed for 100 years, but that's because of the gold standard, right? We're not talking about, in recent history, we have 5 banks around 2010s, 2014 specifically. If this was a private phone conversation, Rosa, then how do we know about it?
Well, we know because it was it was known to everybody that since the early 20th century, these private calls were happening. But what happens is that since the derivatives market expanded very significantly in the last several decades, it provided a whole lot larger incentive to manipulate these prices. Because now, if you move the price of gold by 2 cents, you potentially have 20 or 30 times the size in other derivatives that could benefit from losses on the 2 cents originally in the original market. So it was the increase in the exposure and the importance of these prices that led to the incentive to do so. But this was highly unregulated. And at the end of the day, silver had another benchmark. There was only 3 banks. Deutsche Bank dropped out, and there were investigations. The UK Parliament held hearings, and all of these benchmarks were reformed. None of them exist like that, the way they are right now, compared to how they were 100 years ago. For example, gold now has many more participants. These discussions are accessible by other investors, so no longer there's this private information. So there's a lot of other things that are happening so that you can actually monitor and participate into these calls. And I had that question myself when I started looking. I thought, how is this going on? How is this structure happening for 100 years and nobody ever thinks that this is a potential problem? Well, I did.
Sorry, can we just back up? What do you mean it's been happening for 100 years? Because as we know, post-Bretton Woods, the gold price was fixed because it was pegged to the U.S. dollar at a certain fixed exchange.
So it has nothing to do with
You're not talking about that. Okay.
This is just the way the price of gold, of spot gold, was set on a daily basis.
Okay.
And it was used as reference for swaps, for options, for a variety of other derivatives. And it was also actually used to just purely buy and sell gold. And 100 years ago, they met in a particular location in person and they had these conversations. Over time, these conversations became, started to happen over the phone. And it was highly unregulated. So everybody, just like with LIBOR, when LIBOR rigging was uncovered, prior to that, I used to think, why do regulators let LIBOR be set this way? Why do regulators let gold set this way? Everybody's answer tended to be, well, this has been set like this for a very long time, and that's just the way it is. But as an economist specializing in potential illegal conduct, I think about the structure of a market and the structure in which prices are set and revealed to understand whether not only there's the ability, but also not only there is the incentive, but also the ability to move prices. And not surprisingly, there were many other benchmarks that were found to have been abused, namely the foreign exchange market that Bloomberg helped uncover in 2013. And I reviewed some of their work for their publications, for their articles, where foreign exchange prices were also found to have been potentially extensively manipulated. So this was not a problem just of gold or just of LIBOR, but a problem that was extensive to many markets. And part of the reason is the following. When you have one moment in time when prices are set, and that price is really important for a variety of other products, and only a few participants are able to decide what the price is going to be, you have a potential problem. And so you have to try and increase the participation so that each individual or each company has less ability to move prices. You also sometimes have to increase the window of time where prices that are important are going to be considered. And all of these was addressed in the reforms that were implemented to how these prices are established in 2013, 2014.
So let's go back to the gold price fixing aspect. So first of all, Rosa, do you know what evidence was revealed to the public or indeed to the courts that proved that these banks were colluding to rig the price of gold?
So there were communications in the process of a class action that happened here in the US. There were communications that were uncovered through discovery, and they reveal some of the banks, traders talking to each other and the direction in which they wanted the prices to be moved and how happy they were that prices had been moved.
How were they revealed? Was it just leaked, or did somebody do an investigation?
So these were emails, or I cannot recall whether they were specifically emails or just plain text messages through terminals. They were talking to each other about which direction to move the prices, and they were happy that the prices were moving in a particular direction. Now, I cannot tell you that I recall very many of these. I recall at least one or two of them.
And so when you say direction of prices, it was up and down, right? It wasn't just one direction consistently?
So, good question. What struck me really interestingly in the gold market was that, as you know, when you trade in a market, if you can predict with a high level of accuracy the direction the price is going in the next minute, you can become really rich. And so when I started looking at the gold prices, I realized that around the fixing time, so when these prices were being set, prices dropped in some of the years 80% of the time. And they always dropped by much more than half. So I wish I had known these a long time ago. I would have put my bets on price drops around the gold fixing and would have made a lot of money legally without having manipulated anything. But that was only because I could predict accurately the direction of the prices. So that was one of the things that triggered my interest, was not just the structure of how these prices were set and how it was easy to move them, but also how prices did not seem to behave consistently with an efficient market. And this is a fairly liquid market. And so that led me to believe there was some level of, in the litigation world, we talk artificiality going on. There was something else that was leading to these price changes that were not just normal market movements.
Sure, but do you know if these traders were trading on the long side or the short side, meaning they were pushing prices up for gains or pushing prices down for gains because they had short positions, or was it a mixed bag? Was that revealed?
So at the complaint stage with publicly available information, we showed that their positions were typically short. They were short futures. And so typically, if they were to move the prices of spot lower, that would influence potentially the futures prices that were being determined later in the day and would benefit their short positions.
Okay, so we're talking about positions that open and close within the same day, so intraday trades.
Some of them, yes, but not others. The futures positions, not necessarily.
Okay. Do we know if there was an incentive to do this? Was that revealed in the communications?
There was an incentive of moving prices in a particular direction. I can't recall communications that say exactly why, but then most of the information was never made public. This case settled. And, as I told you, others were investigating these, including U.S. agencies, which led then to the more recent cases on spoofing of metals and others, because as you dig through information, you end up finding even things that you didn't think were there before.
So there's been several high-profile cases of market spoofing, JP Morgan being one of them, as I mentioned. But just generally speaking, what would you need to see from a trader's perspective in the markets, in the prices themselves, that would point to certain irregularities that would warrant further investigation?
Well, the example I gave you before for gold is an example where I see prices going down almost all of the time, or the vast majority of the time. And as a financial economist, I know that can't be a real thing. That can be sustained for a long time because it reveals large inefficiencies in the market that I didn't believe were there, or that there is something else happening in the market driving price changes at that moment that is not the normal functioning of these markets in open market. So different cases have different red flags. In the BP case, I testified on behalf of the Federal Energy Regulatory Commission. For example, there were a variety of conducts, but one of them was also that the manipulator was transporting natural gas from one location into the other when the prices did not justify that to happen. You want to move prices from location A to location B. If prices are, for example, higher in location B relative to A, then you should be moving from A to B. But as I ended up finding out, for example, in that case, the transport from location A to location B had more to do about flooding the market in location B with additional natural gas to depress prices of natural gas at that location to then benefit derivatives positions benchmarked against that price. So that had to do with transport, but there's many other different flags. As I told you at the beginning, manipulators have a lot of creativity on how one may go about it. For example, in the spoofing cases, it might be hard for the general public to absorb some of this conduct, but for example, some traders may be able to see that sometimes some offers and some bids just get canceled too frequently. And that can be observed and can be detected as being unusual. Yes, people change their mind, but sometimes there are too many cancellations at the very last minute of offers and bids that may raise a signal that somebody may be trying to spoof the market.
I want to come back to spoofing in just a minute, but since you comment on BP, do we have evidence once more that there was communication between delivery and the derivatives positions already placed? In other words, was this possibly just a coincidence, or do we know for a fact there was collusion between the physical and the derivative sides?
So there wasn't collusion in the sense of of what we in antitrust call collusion, meaning two separate entities colluding to do this, was only BP. But yes, there are communications and proof, and all of these went through trial where I testify, and that the motive was to depress prices in order to benefit other derivatives positions. And this is all public. And in fact, the Fifth Circuit just a year or two ago upheld the findings of the commission with respect to all of the manipulation charges.
Going back to gold spoofing, or perhaps even silver spoofing, did we have any evidence at all of communication from outside the bank directing traders to do certain trades, or was it just internal decisions made by the traders?
Well, if there, in which case are you referring to? A lot of the evidence never becomes public.
In any case that you've studied, were there entities outside the bank directing traders to play certain positions and manipulate markets, whether by the government or by other hedge funds or private institutions, public institutions outside the banks themselves?
To my knowledge, and I cannot say that I have seen everything that is out there, but I have seen a good amount. I have not seen communications typically where third parties are involved. When collusion is uncovered, it typically just involves traders at different banks talking to each other about moving prices in one direction versus another.
And you raised an interesting point, which is that for spoofing, where do we draw the line between actual breaking of the law, which is spoofing, or just changing their minds? How do we draw that distinction between what is legal and what's not legal?
Very difficult. This is why manipulation is so difficult to prove, and there have been just 2 or 3 manipulation cases proven in decades, because the economist's job is to show that the conduct observed is not consistent with regular economic reasoning. That you, for example, do something in market A where you lose some money in order to be able to move prices in a certain direction in order to benefit a whole lot more than you lost in market A, in some other market B that is tied to A. And so economists develop a lot of analysis that show the incentive, what you have to gain, what you have to lose, how you behave differently in other periods when you didn't have those positions, how you behaved similarly to other market participants in other periods, but somehow you break from them completely in that period, but you only break from them when you have those positions that benefit from these. So economists play a huge role in putting forward what one would say even circumstantial evidence of that is economics, based on economics. But it needs to be counsel who has to prove that, is really you intended to move prices in order to manipulate, not because you believed the direction of the price that you moved into is the correct direction, the true direction, but because you wanted to move it that way because it benefited your other positions. So the intent is a huge component of proving a manipulation case, and that is something that is very hard to prove.
Absolutely. Would you say, generally speaking, commodities are easier or more difficult to manipulate than, let's say, publicly traded equities?
My experience has been that commodities have been the subject to more manipulation than other products. I think that to some extent, some of these did have, as in the gold case, a lot of structures that set up prices that were fairly opaque, conducive to abuse, and lasted for a long time. And so there's been a lot of rigging uncovered there. Other securities, other products are in many cases traded in a more open public market, and information is available to everybody. They are often much more liquid even than some of the commodities, not all. But my experience has been that commodities tend to be a big target for manipulation.
Gold is a $14 trillion market, if depending on whatever the price is on a given day. Are you surprised that this happens at all in a scale that's been uncovered? Because presumably it would take large amounts of capital to move the price in either direction, even for a short amount of time, given that gold is a relatively liquid market in the futures markets, is it not?
Well, so this is the beauty of the financial benchmarks that I mentioned to you before. So I agree with you that if you are going to try and move prices of a market of that size all the time, it's going to be hard. It's going to be very hard to sustain a very high or very low market trend that is artificial. But when you have the cases like gold, where there's a particular moment in time where the price of gold is set for that day. And for example, futures prices have their settlement prices that happen every day. So that's that moment in time where the price of this product is going to be determined and used in a variety of other derivatives. That's the moment in time where you can more easily manipulate, when the structure make it easy. And that's what we uncovered in a variety of commodities is that these structures are easy to abuse. So this episodic type of manipulation is a whole lot more frequent than a manipulation that, in which you would have to intervene in the market constantly to all the time manipulate and every minute the price of a commodity, which would, as you said, require a lot of capital.
Do you believe that spoofing in particular has long-term impacts on the price long-term, meaning the shorter-term price movements would signal over time market confidence in either direction? In other words, I'm wondering, Rosa, is there evidence to support the notion that perhaps spoofing causes price movements in one direction over several weeks or several months?
In a lot of these highly liquid markets, which is one of the key features to determine how long will an effect of manipulation last, most of the effect happens very instantly, but the biggest part of the effect happens instantly. So I would say in the space of a few minutes or a few hours. But that doesn't mean that it may not linger for longer, though that lingering effect, if imagine there's only one episode of manipulation that only happens on that day at that time, the effect happens at that time, then it starts decreasing and quickly kind of dissipates. But in a lot of these cases, you don't just have one episode of manipulation. If you're manipulating a financial benchmark, so that one moment of the day, then that happens sometimes very frequently, 45, 50, 60% of the time. So then you're adding up manipulation effects on top of manipulation effects, and then you can have a longer lingering effect.
So is it possible then, final question, I'll move on to another topic, is it possible to fix the price of gold or silver or any other commodity at a certain range for a sustained period of time, several quarters even?
Yes, it is possible. I don't think you can raise it for a humongous amount or lower it, but it is possible to have an influence, particularly on these financial benchmark periods, as they were set before, in a way that can last for a long time. Though you just have to keep rigging it frequently.
You wrote an interesting article about antitrust and regulatory compliance and the new challenges and opportunities and the role of AI. Can you maybe just summarize some of your findings for us, how AI plays a role in antitrust and perhaps could help regulators and or even help people who may want to manipulate markets? So both sides.
So AI, there's many things that are relevant about AI for antitrust, but one of the parts that agencies are focusing the most are pricing algorithms. So that's, for example, retail has for a long time had pricing algorithms where price changes are determined by code, not anyone in particular, any human being at any moment in time. And the fact that competitors have all their data out there, all the prices are there, you can easily look into other competitors' prices and determine your price. So there's this process of machine learning of capturing everybody else's prices from your competitors to inform how your price should be and vice versa. And that process, that high level of transparency and the ability to react quickly to competitors' prices and market conditions can be really good or can be really bad. It can be really good in a market that it has a lot of competitors and is not concentrated. That may facilitate and strongly enhance competition. Because if no player has a significant level of market power, if you see that your competitors are lowering prices, you are immediately drawn to lower prices as well, or you're going to lose most of your customers. But in markets where the concentration is high, there's a couple of large players. Those pricing algorithms and the availability of so much data publicly can lead to outcomes of too high prices, and namely to collusion, for example, among competitors, where the pricing algorithms can monitor each other and test whether, well, let me see, if I raise my price, will my competitor follow, or will he keep his price lower? You can try that out and see how your competitor reacts. And if the competitor raises its price as it sees you raising your own price, now you're starting to lead to an outcome of higher prices that is undesirable for consumers. So antitrust bodies are very concerned with the potential of market abuse due to these pricing algorithms and other aspects of AI. With respect to trading, sorry, go ahead.
Oh, no, please continue. With respect to trading, yes.
These pricing algorithms have existed for a very long time. Top traders have been devising pricing algorithms based on information that tends to be common to all of them. Everybody else's prices, everybody else's positions, whenever they can know something. So to a great extent, this is not a new topic. I think it is new to the antitrust arena for the last decade or so. But in finance, these pricing algorithms have existed for a long time. And if anything, as I have argued often, for example, when you think about trading moving from over-the-counter to exchanges, where over-the-counter is all is not very transparent. There's intermediaries, and they obviously get a big cut out of the transaction. When you move to an exchange, everything is a whole lot more regulated, but also much more transparent. As a trader, you can see all the bids and all of the offers, though you don't know who's bidding and who's offering, but you can see how the market depth, you can see how everything evolves. And based on that higher level of transparency that typically exists also in exchanges, there have been pricing algorithms being set for a long time. And what we observe between the two situations is that the spreads are much lower in these exchanges than they were in over-the-counter. And that is not just a function necessarily of the lower intermediation, is a function of the benefit of more transparency in the marketplace. So these pricing algorithms to work require more transparency. You need to have everybody else's data in order to be able to incorporate it into your own pricing algorithm. And having everybody else's data is not necessarily bad. It depends on other features of the market, including, as I mentioned earlier, whether there are many competitors or just a few.
Trading bots are now able, and they have been for a while, are now able to place trades on their own given certain parameters and inputs. If we have AI that potentially uses machine learning to create their own parameters, starts trading, starts using trades that may be classified as illegal, for example, whose fault is that? The computers or the people behind the desk who's not really trading, right?
That is a big, big problem that is starting, that people are trying to address. Who's the ultimate person responsible for the code? Who's writing the code is going to be, and who's telling that person to write the code? Who's making the decisions on what kind of functions you use, what input data you put in, and how you're using the output data? all of that, those people would be the people that would be responsible for it. But on the other hand, I don't think you can really go after companies for some of that conduct if you have not ahead of time set up the rules to tell them, here's what you can do and here's what you cannot do. And this is where I think we're sitting right now, is trying to decide what the rules should be so that everybody knows what to count for, and you can finally say, okay, you did not comply with the rules and therefore now you are liable for X.
Given your many years of experience working on many fraud cases and manipulation cases, do you still think that markets are efficient? Do you believe that hypothesis?
Yes, I am a University of Chicago economist. I am a big believer in markets. Markets are efficient. Are they perfect? No, not necessarily. People can abuse sometimes here or there, but they are superior to any other potential alternatives of more centralized price setting. And in fact, it is when the price is centralized, like in the moments in times that I tell you, that things tend to be more often wrong. When prices are set in the open market, yes, sometimes there's abuse because it depends on how big the players are, etc. But it is less frequent than when there is a more centralized period of time when the price is set by just a small set of competitors. So yes, I am a big believer in markets, but I also think we should monitor them. We need to keep our eyes open for market outcomes to try and see where red flags may exist in order to be able to preempt potential anti-competitive conduct.
Well, how do we make final question, how do we make regulation to prevent, let's just take specifically spoofing in the metals markets, for example. The traders already know, presumably, that certain conduct is not allowed, yet it still happens. How do we prevent that, preemptively prevent that from happening? Is it possible?
Well, you have to set an optimal level of rules. What the right mix of rules is difficult to set, but you might tell the trader, look, if you change your mind more than X times a month, that doesn't mean that necessarily you did anything wrong, but I may take a look at you. I may go look at why are you just canceling all of these bids and all of these offers. It may lead to nowhere, and I would expect more frequently will lead to nowhere. But I think that informally traders already know that if they do engage in a lot of this kind of conduct, they will signal potential wrongdoing, and agencies will look into them.
Okay, fantastic. Where can we follow your work, Rosa? Where can we learn more from you?
Well, I have a good amount of papers. They're posted on SSRN, many of them on manipulation. And of course, I am a frequent testifier in those matters. Currently, I am the expert for the Federal Energy Regulatory Commission against Total Energies in another natural gas manipulation case. So let's see how that plays out.
Okay. Well, thank you very much for your time today, Rosa. I appreciate it. And make sure to follow Rosa on the links down below. Thank you.
Thank you. It was a pleasure talking to you.
My pleasure as well.